Let's have a look at the question called Spandau.
161.
Page 161. Page 161. Discuss the accounting treatment of the inventory. Discuss the accounting treatment of the derivative. You need to read this. Spandau has inventories of a precious metal, and these metals cost 9. But the market value is 12. Now what we're concerned with is we think the market value has peaked. So we're sitting here in October 15, sitting on an asset which cost 9, but we think is worth 12. Now, we think we're going to sell this asset next year. Now, when we come to sell the asset next year, we are worried that the price that we will get won't be as much as 12. So, in order to hedge the risk, we enter into a contract at no cost to sell the inventory for 12. So we fix the price. By the reporting date, the fair value of the inventory has fallen by 1 to 11. And there is a corresponding increase in the fair value of the futures contract because we now have an asset which is worth 1. The nature of a hedge, the nature of the derivative, is that it is being designed to act as a counterbalance. Because the value, the price, the cash flow we're going to get from the gold has come down, the value of the derivative has gone up. So what you're doing there is you're covering yourself. I need to answer the question. Discuss the accounting treatment of the inventory. The word is and, so therefore there are 2 questions. What's the inventory? What's the derivative? Let's talk about the inventory. How do you value inventory? Lower of cost and net realisable value. So, inventory is valued at the lower of cost. Inventory is valued at the lower of cost and net realisable value. Therefore, at the year end of 31st December, what number do we have for the inventory? 9, 12, or 11? 9. It will be at the cost of 9. The fall from 12 to 11 is unrecorded, because that is a fall in a potential future cash flow. Let's think about the inventory. Let's think about the derivative. The derivative, the futures contract, must be recognised at fair value. Therefore, at the year end, 31st December 15, we have a fair value. What is the fair value? 0 or 1? 1. Ladies and gentlemen, I have a problem. It's not working for me. The gain on the derivative is normally recognised in P&L. It's normally recognised in profit and loss account. Yeah? So what you would normally do is you would normally debit the asset by 1, and you would credit the profit and loss account by 1. So that is what you would normally be doing. I need to put my pen down, and I need to stop, and I need to think. What's happened is, what we are trying to do is that. What we are trying to do is offset. What we're trying to do is match. What we're trying to do is pair. Because we have suffered a loss. We are going to suffer a loss on the sale of the gold. Because when we come to sell the gold, we'll only be able to sell it for 11, whereas we thought we were going to sell it for 12. What we've done is therefore create a profit of 1 on the derivative. I don't want that profit of 1 in this year's P&L. I don't want the profit of 1 in this year's P&L. I want to carry it forward so it can be recognised in next year's P&L. So I can actually say that the revenue next year is 12. That's what I want to be able to do. I want to be able to carry forward the gain. Hedging. To reflect the substance of hedge accounting, we need to be able to offset. To reflect the substance of hedge accounting, we need to be able to pair. And what is happening is that we have a hedged item, which is a risk in the fall in the fair value, a change in the fair value of an asset or liability, or a change in a future cash flow. We have a hedged item with a risk. We have a derivative, which will then be the hedging instrument, which then throws up the corresponding gain or loss on that item. And we need to make sure that they are paired. This is a cash flow hedge. So this accounting does not reflect the substance. So instead of recognising the gain or loss on the derivative in the P&L, in order to reflect the substance, we'll recognise it in OCI. And then we will, to use that phrase again, recycle it to P&L in the next accounting period. So, let me see if I can write down the gist of that. Well, this derivative was entered into as a hedge. as a hedge, i.e. a risk management process where a designated hedging instrument is to cover a designated hedged item. A hedged item is an asset or liability or future transaction a hedged item is an asset or liability or future transaction that exposes the entity to risks of changes in fair value or future cash flows. So a hedged item is an asset or liability or future transaction that exposes the entity to changes in the fair value or future cash flows. If you have loans, if you have variable interest loans, then you're subject to interest rate risk. If you borrow money, there is the risk that you might have to pay more back if interest rates go up. If you've got foreign currency balances, if you've got foreign currency probable transactions, then you've got a foreign currency risk. If you've got an equity investment, then you've got a price risk. Foreign currency risk. Look, I need to stop. I need to calm down. Life is full of risks. If you borrow money, the risk is interest rates go up. If you have foreign currency transactions, the risk is you'll end up with a foreign currency loss. If you buy shares, the risk is the price will go down. But do you know what? Could go the other way. Could go the other way. Interest rates could fall. You could have a foreign currency gain. The share price could go up. Now, management have to make a decision. What is their strategy? It may be that we're selling goods in ringgit, yeah, and that we have customers who buy goods in ringgit, and we know there's a ceiling on the price that we can charge our customers in ringgit, and our raw materials are in dollars. And if the price of our raw material goes up because of exchange rates, that could wipe out our profit and wipe out our business. Now, in those circumstances, it would be prudent, it would be sensible to fix the price, to manage that control, to manage that foreign currency risk on the goods that we're buying by entering into derivatives to buy dollars at a fixed price so you can guarantee what your profit margins are going to be. But other businesses will just say, we'll take the rough with the smooth. So we understand that for hedging to occur, there has to be a risk. And the idea is you identify that risk, you measure that risk, and then you want to cover it with a derivative. Now this is again beyond your necessity for detail. But the idea is that the derivative that you choose, or that is chosen for you, is a counterbalance. So that if the price of the underlying item is giving you a loss, if your hedged item is giving you a loss, your derivative will give you a gain. Yeah? So if you have a risk in respect of $200 million, then it would make sense that your derivative is in the context of $200 million or something like that. If your risk is to do with oil, then your derivative should be to do with oil. All right? So, we understand that we have a hedged item. A hedging instrument is the designated derivative whose changes in fair value are expected to offset the changes in the hedged item. A hedging instrument is the designated derivative whose fair value or cash flow changes are expected to offset changes in the hedged item.